I also think that every cycle that goes by, the kind of the reasonable allocation changes somewhat. So, for example, 10 years ago, the kind of expectation of Bitcoin was a lot less clear. It was a newer, more kind of emergent asset. Every time Bitcoin goes through another big cycle and is still here and larger and more mature in various ways, with more clarity around its future, the sensible allocation likely gets a little higher. And at some point, maybe the returns diminish after a certain point, but then you're starting from a larger allocation to it. Basically, as it transitions from emergent money to just utility money, basically it's money that is just it's money now. That kind of changes the percent that I think makes sense in a given kind of volatility minded portfolio.
Yeah,
Absolutely.
you guys have both mentioned the 60/40 portfolio, and I just wanted to reference a tweet that I saw from Lynn's. I think it was yesterday. I think it was making its rounds regarding an interesting story of birds in the street, maybe if you look at the bond market. And so just curious your perspective on that, because unfortunately, a lot of people get allocated to a larger bond allocation than maybe they wanted to, just because of their options in some of those portfolios, those traditional portfolios. Maybe do you want to discuss the risks there, at all,
Sure,
in
I think
regards to Bitcoin? Yeah.
yeah, the bond market's been fascinating because, it's been doing very well for 40 years on a risk-adjusted basis, basically low volatility, decent returns. But starting several years ago, call it 2016, 2017, 2018, especially that 2018, 2019 period, it was in such a big bubble, and it was one of the quietest bubbles around. Basically, yields got down to like nearly 0%. In some countries, they were negative. So they're negative yielding bonds, including some corporate bonds, meaning you're paying a corporation to borrow money from you. And there, at one point at the peak, there was over $18 trillion worth of negative yielding bonds, primarily in Japan and Europe. But even in the United States and other developed countries, they were very, very low, which means that you basically have risk without any possibility of return. And Obviously, the inflation wave that ensued wiped out the purchasing power of those bonds. And in addition, even a modest increase in yields severely damaged their prices, their purchasing power. Um, and so, and what we're seeing now is I think there's kind of a very slow realignment happening, but most investors are still thinking over those past 40 years. You had 40 years of declining interest rates. If anyone's not familiar with the bond market, falling bond yields means higher bond prices. Um, and so you had 40 years of declining bond yields, rising bond prices, good income, just good kind of low volatility growth. But going forward, after we bounced off zero rates or negative rates in some cases, there's not a ton of upside left in the bond market, and they still face risks from inflation and higher yields and fiscal dominance and all that. And so they can have good years and bad years, just like any other asset. But overall, the kind of the risks are skewed to the downside. And but a lot of portfolio models have not in any way adjusted yet. And so they're still kind of in the mindset that bonds are a defensive asset. And 2022 is a really good example because usually if you have a decelerating economy, so purchasing managers indices rolling over, other sort of rate of change indicators about the economy rolling over, normally bonds do pretty well. And that was an environment where bonds sold off along with a decelerating economy. And there's certainly risk that that could happen in future kind of deceleration cycles. And I just think that the market has not really adjusted to that kind of changing market regime yet.